Welcome to Barchart series of educational webinars designed to enlighten you on a variety of investing ideas and concepts, inform you of the features and tools Barchart provides related to these concepts, and offer you some trader's insight to help you make a more informed investing decision. Today's session, mastering the cup and handle formation. Now, one of the components of modern technical analysis is pattern recognition. And the art of pattern recognition attempts to predict price movement based on similar movements or patterns that were created in the past. Now, technical analysts will name these patterns after the formation setups or the potential result. Names like head and shoulders or dead cat bounce, diamond top, just to name a few. Today, we're going to explore the cup and handle pattern. It's a popular chart pattern that identifies rounded bottoms with a slight pause or drawback consolidation before it breaks away from a recent multi-top range. And although, like all patterns, there is a fractal nature. In other words, they can appear in all time frames, from the micro minute to the macro monthly. We're going to focus on the intermediate and long-term dailies and weekly patterns for various reasons, but because of the longer duration for development and the potential outcome, an uptrend and greater reward. So stick around as we learn how to drink up profits from the cup and handle pattern formation. Now, before we get to all of that, please welcome our moderator and Barchart's project director, Gene Baker. Hello, Gene.
Happy Wednesday, John. How are you?
Hump day.
Yeah, hump day. Hump day, hump day.
How are you doing?
I'm good. I'm very busy over here, but always happy to jump in on one of these Wednesday webinars and learn a little bit from you.
Well, I always appreciate you helping me out. I can't do it without you. So thanks so much for making time for me today, Gene.
No problem.
All right, you ready to get started?
Yes, I am. Let's get going.
Let's go. All right, so just to remember that today's session is for educational purposes only, and decisions to buy, sell, hold, or trade securities, commodities, or any other investments involves risk and is best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any losses or damage that you or anyone incurs as a result of trading investment activity that you or anyone else engages in based on the information or material you receive through barchart.com and or our services. Okay. So the cup and the cup and handle pattern is a rounded bottom, pause, consolidation, retreat, then breakout pattern that can be found in two phases of trend analysis: after a protracted downtrend or in the intermediate phase of an established uptrend. Now, they're typically located near a significant level of resistance, for example, a multi-month high or maybe the 52-week high. The cup formation, the price rises initially, peaks, and then declines to form this rounded bottom. After hitting the bottom, then the price rises again to the previous peak, forming the right side of the cup. Now, the peak to trough should be significant in terms of a percentage or a range of past price. In other words, something like 30 to 50% in terms of price movement, or we could say a large percentage or the range over the last 52 weeks. The handle price pulls back slightly after reaching the previous high and forming that handle. Now, this pullback usually does not exceed the depth of the cup by more than 50%. Now, in terms of probability of success, pullbacks in the 10 to 15% are better than deeper penetrations, and which also deeper penetrations have a higher failure rate. And when we look at handles that are created in continuation patterns from prior lows versus newly established rounded bottoms, and tend to be a little bit more reliable. So that's the textbook example as it appears. But in reality, it's a lot more subjective and what I would say janky. Now, the key is going to be a variety of data that is created during formation to help us to determine a successful pattern. Foremost, but not the only, is the pattern of volume. Volume helps confirm price and the positioning of price on or above some key moving averages. And the moving averages will also help smooth out price data, that randomness or that volatility, and it makes it more visually recognizable. All right, so let's look at some examples, and we'll also talk about structure. Let me get this kind of set up so you can see this. There we go, a little bit better there. All right. So this is really a classic formation of a cup and handle. First, you see our pullback from our peak on the left side to our bottom. So we're up here around $12 and we fall back down around or just below $8. So that's about a 35% peak to trough retracement. Now the bottom rounding is found at the 200-day moving average. Now, just for reference here, the black line is the 200, the blue is the 50-day moving average, and the red is the 20. These are all simple moving averages. So this is kind of what we want to see. We want to see the market pull back to our 200-day moving average, or it's being supported by our moving averages. In other words, what we want to also see is some of those crossovers. You can see here the 20 crosses both over the 50 and the 200, and the 50 crosses over the 200. So this would be supportive of our bottoming action. Now, in this case, this one is well inside of an established uptrend. We can find cup and handle patterns when we're making new or let's say 52-week lows. Again, in terms of formations, these types of cup and handles have a little bit more reliability. The handle, you can see, is more of a sideways to a slightly drifting lower or declining. Now the price action does begin near or at the previous high and falls only about, in this case, you can see about 10%. Again, in terms of what we want to see the handle to do, we don't want to see the handle fall, let's say, more than 50% into our cup. That is probably going to be a cup and handle that is going to fail. So this is kind of right in that sweet spot that we want to look for. Now the breakout here happens to be on a gap, and we've talked about gap theory before. This would be a great not only confirmation of price action, but certain types of strategies, something called a gap and go strategy, to allow us to get into this trade. Now we're going to take a look at volume and high volume, as you can see down here, in a moment. But one of the things that we can do is, the human eye likes to look for patterns, but sometimes the patterns aren't as accurate, or we're not really seeing that textbook, pure rounded bottom. So that's why moving averages tend to come into, help us in this process. So what let me do is let me take away the randomness of price, and now we're just looking at our moving averages. And you can see here on our moving averages, you can see that bit of that cup action, right? That cup action that is supported by a higher time frame moving average, and then our little handle here, a little handle action as well. So that is one of the reasons why we want to kind of use moving averages to help us with looking at our potential cup and handle structure. So now let's talk about breaking down the structure. So the cup itself, right? Well, hang on. Right, we want to kind of see that U shape, right? That rounded bottom more than we want to see the V shape. But in reality, when we start to look at structure, what we might see is a couple of these V bottoms are stacked on top of each other, and they could give that appearance, or that effect of rounding. Again, this is probably why using moving averages is going to give us a more focused lens. The duration. So the duration for these patterns typically take about somewhere between 7 to 65 weeks. So listen, the point being here, for instance, in this one, let's look at this one. This happened over 213 days, or about 42 weeks. So the point here is that cup and handle patterns take a long time to develop. Now, yes, can we find cup and handles in lower time frames? For sure, that is part of the fractal nature of markets. But what it comes down to when we look at cup and handle patterns, that we want to make sure that the number of periods is much longer in the cup and shorter in the handle. Now, William O'Neill established the standard of this 7 to 65 weeks in this, what we call this intermediate to longer term development. Volume. So volume tends to decrease as the stock forms the bottom. And then as selling pressure decreases, the volume will decrease. As you can see right here, we can see volume is decreasing as we're getting into this rounding action. But buyers step in, and volume often spikes or rises as a bottom is being created, and you can see that here. Now, that is something that is universal, or I would say generalizations of buying actions, and not necessarily what is typical in a cup and handle. Is definitely something that is more of a universal, a spike in volume at near or bottoms, and also on the reverse as tops. Now the depth, again, we talk about, decline should be moderate, typically in that 30 to 50%. But again, we could look at this in a reference of our 52-week highs and lows. So here's, if I go back in time, here's our 52-week low, here's a 52-week high. We go from about $2 to $12, and our dip here is about $4. If I look at it, let's say during the duration of the cup, we go from about $6 to $12, and again, that's a retracement. So again, it's about a significance of depth, but also we kind of want to look at that in terms of that big picture. And again, where are previous highs and lows and how do they line up in terms of, maybe our 52-week highs and lows. Now the handle appears as a small consolidation, and it tends to have a little bit of a pullback. Now, it's usually a downdrafting, as we pointed out, but again, in terms of the duration, the duration usually is, somewhere between 1 to 4 weeks. In this example here, I think it was about 6 weeks. Now the volume decreases during the formation, as you can see here is the formation of the handle, and again you can see the decrease in volume. Now on the breakouts, right, breakout from the handle, that's where we usually see that significant increase in volume. So again, when we start thinking about what would be a significant increase, I think we want to think about something like in a 2 or 3x of what would be the lowest volume in our bottoming action. Or if we do see something like we see a little bit of a peak volume as the market is bottoming, then I want to make sure that this volume is equal to or greater than this bottoming peak action. And again, notice the sloping downward. Now there are variations. We could see something like as more of a sideways action, or you might even see an upsloping handle. But upsloping handles have a much higher failure rate. Now think about this in a line of, like a 2-liter bottle that has already been opened, right? The price pop has already partially occurred. So an upsloping handle might get you a response, but lots of times you'll get a little thrust action and then, a reversal or a failure. All right, so let's look at some variations and some examples. Now, again, right now, the market, and I'll address this a little bit later in the webinar, is not conducive to a lot of cup and handle formations. So I always like to try to give you guys examples that are in real time. So it's been a little difficult doing this, but let's look at a couple of examples and look at some variations. So in this case here, we can see our cup, and then we have our little bit of our handle here, and then our breakout. Now, a lot of times these types of cups and handles will look like, again, if I look at the randomness of price and then I take that out and I just look at my moving averages, what do I kind of see here? Well, yeah, the 50-day moving average is certainly a very cup-like, but what does the 20-day moving average look like? And for those of you who are astute pattern recognitions, well, here is what I would consider an inverted head and shoulders. So the human eye likes to find patterns. It just makes us feel at ease, and we like to find patterns in randomness. But I will tell you that cup and handle patterns tend to have hidden inside them these little inverted head and shoulders. All right, so let's look at this one. And what we see here, again, looking at our moving averages, our 50-day moving average, more cup-like. Our 20 is more, kind of this V bottom-ish, right, stacked upon each other, but it's giving that effect of a rounded bottom. In other words, higher highs and higher lows. Now, what makes this cup and handle a little bit more distinctive in terms of why we didn't get such a big movement past the breakout in terms of our development here? And that is because we are not getting a support from all of our moving averages. Here you can see our 200-day moving average is still down sloping. And the 200-day moving average sometimes is a hard nut to crack. And once we cracked it, we didn't get that follow through. So that is something that you need to be aware of. We kind of want to make sure that all of our moving averages are in support of our cup and handle. But also on this one, if we look at, let's say, our volume, you can see that in the case of this example, right, what did help create a nice follow through, or at least in the short run, was that our volume was substantially more than it was at the peak volume at the bottom. Again, a nice little cup formation. If we look at this in terms of our moving average, is much more cup-like in the 20-day moving average, even though the randomness of price is more of these backwards, back and forth price action. Again, but what we see here is a series of higher highs and higher lows, which is a way that we can define an uptrend. And again, in this one, we see a lot more support of our moving averages. Now, what makes this one a little bit different is, yes, we see a increase in volume as we're getting to break out of our handle, but it's just about equal to the peak, but it's definitely, I would say, a 2x of our peak low volume, or our bottoming volume. So that is something that also you want to make sure you continually to look at that volume comparison. Now, I don't do a lot of Forex in a lot of our examples, but I do like Forex when we talk about cup and handle patterns, because they take so long to develop, especially when we're talking about these higher time frames in terms of creation. But again, here is the US dollar versus the Indian rupee, and we're talking about a structure that took almost 2 years to develop. And that's really one of the nature of Forex, patterns that it created in Forex, just because of how it's very difficult for trends to change in, let's say, the macro of Forex, that it takes a long time. But let's look at this in terms of another example. What we can start to look for is, first of all, notice our randomness of price. Again, why we kind of want to look at that supportive moving average. Again, you can see a lot of randomness even in our moving averages that is kind of smoothing it out, but you can definitely see that cup action, and then there's that little handle before we break out of our previous peak highs. But also what I want to talk about in this example is something called the fractal nature of markets. And so what I've done here is I'm going to go down to a 4-hour time frame. Now, when I do trade Forex, or when I'm looking at Forex, I do like 4-hour time frames. I just feel like that is a great time frame to look for structures, patterns, and opportunities. Now, that is my own personal preference. You might find something a little bit different. But again, there's that pink box that represented our handle at our higher time frame. But notice what happens when we amplify this, and what do we see here? Again, a kind of a rounded bottom, right? Maybe a little bit of a V bottom, but rounded is certainly in terms of support of our moving averages. Our smaller time frame moving averages are in support, and they are above our longer term time frame moving average. But what do we see here? A rounded bottom with a little bit of a handle. So this is called fractal recognition. When you see the pattern repeating itself at lower time frames, this is a positive probability. In other words, if I see a couple handle inside of the handle at a lower time frame, when price does break out, there's a much higher probability you're going to get a much greater response of the market. So look for that as well. This fractal recognition throughout all of your time frames. Okay. So let's talk a little bit about interpretations of cup and handles. Again, it's interpreted as a bullish continuation, and the pattern is considered bullish because as the market breaks out of these previous highs, it tends to have a continuation of that existing trend. Again, why we want to kind of see that supportive evidence in our moving averages. It makes a lot more sense. The breakout point. Now, ideally, we want to look at those resistance levels, those high points on the right side of the cup and the handle, and this is where we're going to look for that breakout point, but also our entry level. Again, we want to make sure that we will see increase in volume. As far as our price targets, right? So there is this extrapolation that we can look at, that we can measure the depth of the cup, and then when we break out from that breakout point, we could add the depth of the cup to the breakout point. So in this example, if the cup is $10 deep and we break out, then the price target should be $10 above the breakout point. Now, that is, kind of a measuring stick, and that is very scientific. And the reality of the real world is that, you need to be a little bit more conservative. So again, from a trader's standpoint, I might measure a $10 movement, but I probably would look to set a target of maybe, let's say, 80% of that movement or 85% of that movement, or that when I get to, let's say, 80% or 85% of that price movement, I'm definitely going to be looking to manage my risk. In other words, some kind of a trailing stop to lock in profits. So we can also look at some technical indicators that will also help us to identify these cup and handle formations. So again, I mentioned short-term moving averages. We want to see them in support of our cup and handles, but we want to see this combination of the short terms above our longer terms. So the example that I gave here is, the 20-day over the 50, but 50 obviously above the 200. A confirmed breakout. Again, our moving averages should already be in a bullish crossover, right? The 20 has already crossed over the 50. The 50 has already crossed over the 200. Now, you might see in the handle, if you're using a much lower short term, let's say a 5-day, 3-day, or 9-day, you might see that fall below maybe one of these intermediate moving averages. But you certainly want to see that turn positive as you are breaking out of your handle. Now, relative strength is a great tool in these types of formations. We want to make sure our relative strength is not overly bullish. In other words, we don't want to kind of be in that 40 to 70% tile, showing bullish momentum again, but not being overbought. Now, as far as support and resistance, we know where resistance is. Resistance is the right side of the cup or the top of the handle. But let's also check for support, and that support should be found around the low of the handle. I don't like to find cup and handles where the handle makes its own low. I want to make sure that low can be correspond to, let's say, a previous high or a level of support that has already been created. That just gives me a little bit more confidence. And then again, that volume criteria, right? That volume is a lot less during the handle formation, um, and then we want to see that spike. So here is a kind of just a general rule. I want to see, volume about 20% above the 50-day average on the breakout. Again, you can look at that on a very statistical basis, or you can just kind of eyeball it and say, hey, is my volume a peak volume compared to what you see during the cup formation? So once we've got the idea of what a formation looks like and then the structure, now we know the basic interpretations. Let's talk about setups. Let's talk about how we can manage this from a trading aspect. So first, again, identifying the pattern. We've talked about this now, this rounded shape, right? Where we want to find, this kind of deepness, somewhere in that 30 to 50% from the peak. The handle, right? Much smaller consolidation, a pullback, again, a shorter period of time. Again, we don't want a deep penetration. We want to be in that kind of that 10 to 15%, 20% maybe of our cup's depth. And then we know our entry point is going to be where we break out from resistance from those previous high points. And again, looking for that significance in volume to confirm our movement or strength. So where are we going to set our stop losses? So first placement, I'm going to set my stop loss order just below the lowest point of the handle. And this is going to protect me against false breakouts and minimize my losses in case this position doesn't work, in case the market reverses on me in a very short period of time. Now, I will make adjustments of this trade as it progresses. And moving my stop loss order to first break even, or as the market starts to reward me, to my swing lows to help lock in profits. Now I'm going to show you how to do that in a second and how we can use some technical analysis tools to make that assessment. And again, that profit targeting. Again, I want to be a little bit more conservative, but we can certainly measure the depth of the cup and extrapolate that to our breakout. All right, so let's go back to our chart. And what happened to my cup and handle? Okay, that's weird. All right, so here we are. There's our cup, there's our handle, and there is our breakout. All right. Our breakout is confirmed by a large amount of volume. And what was nice about this example was this was a gap and go. So again, they could use a very unique technique based on gap and goes. But knowing that our resistance here is around $12, or even if we wanted to use, this, highest close here, maybe around 12.10, 12.20, as our confirmation of our entry level, that would be where we'd be looking for our entry. Where are we going to set our stop? Well, our stop initially would be at the low of our handle. So what I can do now is, as this is developing, as this is going, I'm going to drop down to a lower time frame here. I'm going to go down to a 30-minute time frame. What I can do is I can start using some technical analysis that'll help me confirm a breakout. Now, one of the tools that I like to use is something called the average true range. And if you've been in any of my webinars, what I talk about, how we can use average true range to help us confirm price movements. So over here where it says, I'm in our new charts, by the way, this is our new beta flip charts, but on the right hand side, it does say more data. I'm going to go into more data and I'm going to look under technical. And here's a 20-day average true range for Daktronics. And you can see that it's about 70 cents. So the general rule that I use is somewhere between 1.5 to 2 times my average true range would be a confirmation of a breakout. So 1.5 to 2 times would be somewhere between $1 and $1.40. So once price goes at least $1 to $1.40, that to me would confirm that the price breakout is real, or at least legitimate. So once that occurs, now you can see that that happens somewhere right around here's $1 and there's your $1.40. It really happened right in the first candle, the first 30 minutes of the day. At this point, I have two options. I could move my stop loss from the low of the handle to the origin of this move, or as time goes on, especially if I'm talking about another 2 or 3 periods, there's less likelihood that we're going to retrace all the way back. So I could set my stop at just below my entry. Now I want to make sure that that risk that I take, that first initial risk, in this case, it looks like it's around 10.57, and let's say we bought above $12, so we're risking about about $1.50. Again, our target was that range of our cup, and if we remember, that was somewhere around $4. Well, that would put our projection around somewhere around $16. Again, I want to be a little bit conservative in sort of setting targets, but my risk to reward, I want to make sure that I don't putting on 1-to-1s or 1-to-2s, right? I want to try to strive to get at least 3-to-1. But 2.5-to-1 to 3-to-1, I think that would be a good trade. Now, again, the initial risk here, $1.50 for, let's say, $4, but you could see that within a couple hours of this trade, I could have moved my risk to a point where I might only be risking maybe $1 to make potentially $4. And then certainly as price makes new highs, then I can start adjusting my stop off of these swing lows. So make a new high, I can adjust my stop off of a swing low. Now we never want to put our stop right on the price. We always want to add a little bit of buffer. Now the buffer is going to be based on an individual trader's preference. But for instance, like in in any of our equity markets, if you use, let's say, a 10% of your daily ATR, in this case, it was 70 cents. So if I used a buffer about 7 cents, somewhere between 5 and 10 cents, I think that would be a good buffer off of one of your pivot lows or pivot highs when you set a stop. All right, so that's kind of how we can manage a trade as it plays out, how we manage our risk reward, and how we look at that in terms of, do we want to take this trade? Because a lot of times we might set one of these trades up and it might look great on paper, but once we do the math, we realize that we're taking a lot of risk for a limited amount of a reward. The other thing I want to kind of talk to you about in terms of cup and handles is initially you get that impulse move, right? And you can manage that. Again, you could, for swing traders, you could just play this trade as it goes. Um, Options traders, you could look for some bullish options trades. But a lot of times what you will see, and this is one of the natures of cup and handles, a lot of times the price just not doesn't run straight away, just doesn't continue to go. Remember, we're talking about this is helping us identify a new uptrend, and new uptrends are a series of higher highs and higher lows. And so what you typically do see is after the market makes a new peak high, you will have a retest or a retracement where you're going to make a new higher low. And that higher low tends to be in the area of where the cup and handle broke out. So at this point, you could also take another re-entry trade, or you've identified a cup and handle, you've got the impulse away, and now we're waiting for that retest. Sometimes the retest comes, sometimes it doesn't. But in this point now, we could manage our risk a lot better, and we know that where our target is. Our target would be, as a trade management, would be where this recent peak top is. So then my entry could be based on a formula of where is my risk going to be versus where my potential reward is. So keep that in mind. A cup and handle is, from my perspective, I think, it's not one of the greater patterns, but what it makes it nice is that you can catch that initial move, and usually it's a nice, good potential for risk reward. But if you're patient, again, remember this pattern took a long time to develop. If you're patient, there probably will be a second opportunity to enter into this, what looks like the beginning of a new uptrend. All right, so let's do this. I want to show you some other aspects, but I want to take a second here, Gene, to answer a couple questions. I see you've been answering a lot of them for me, so thanks a lot, Gene. Okay, so Brian says that there could be a long-term 20-year max Swiss franc dollar cup and handle formation. Brian, I'll take a look at that maybe in a moment. But yeah, I mean, in Forex, I think you will find a lot of these type of cup and handles formations in much, much higher time frames. Can we use filters for identifying cup and handles or just visualizing the scale? Oh yeah, I'm going to get to that in a moment. And can unusual options assist in identifying cup and handle patterns? So I think that there is that, Aman, yeah, I think both of those questions. First of all, I'm going to show you where you can use filters. But, an unusual options activity might be part of a catalyst that creates that breakout, right? Now, what could be some other catalysts? I would think earnings would be one, right? So, yeah, I think some of those things, again, I'm not really concerned about what caused the price action. I just want to confirm the price action with what? Make sure that we see that volume and we take out that previous high. So the question is, where can I find my potential candidates for cup and handle? So inside of our chart, inside of our website, there is a page called Investing Page, and we have our bar chart screeners. So we don't have a screener that is per se just for cup and handles. What we actually have is we have two screeners that are going to help you find potential candidates. Now, the first one is called the J pattern. Now, the J pattern screener here is really looking at that hook pattern at the end of our handle. And notice, remember, our handle falls and then it shoots up. If you imagine that, it looks like the letter J. So you're not, these are not going to all be handle J hook patterns, but you will find those type trades in this screener. Now, I looked at this morning, and the one that kind of pointed out to me was this Axon, which was, right? So again, these are not going to be all cup and handles, but you can see in this case, let's kind of look at it here. Again, the math, the way it works out, this one was a very deep penetration. So probably something that we maybe might not like, but you can see that what I'm talking about is there's that J hook kind of pattern. Again, not all of these in this filter are going to be J hook, part of handles, but you will find them in here. So this is one place that you can look for them. And then the other is in what we call the upward base consolidation. So what this filter does, it looks for those stocks that have that supportive momentum, supportive moving average. In other words, what we're really looking at is the right half of our cup and handle as the market is making that kind of sideways, but ever increasing higher highs and higher lows pattern. So I looked at these this morning, and again, these are not going to be all cup and handles. As a matter of fact, I went in and looked at the ones that came up today, and none of these are cup and handle patterns. But again, you will capture a few of them. So if you want to do something a little bit more unique, or you want to kind of tweak this one, because I think this one tends to capture a lot more of cup and handle type patterns. I'm going to come back into my filters here, and I'm just going to make a couple minor adjustments. And the first one is, notice here it says number of 1 month highs, and here we're making it use a filter of 5. But think about it, what is a cup and handle, right? We have made that peak high on the right hand of the cup, and then we have that down price action. So we don't need 5 highs, we just need 1 high. We just need that 1 high on the right side of the cup where the handle starts to be developed. Now, the other thing that I will do on this one occasionally is, if I'm not getting a lot of candidates, I will remove this 9-day oscillator. 9-day oscillator that is less than a 50-day oscillator. Again, maybe we do see price move lower in our handle, but this kind of eliminates a lot of those potential cup and handles. So what I'll do is I'll just take that one out. So 1 new monthly high, and eliminate the MACD oscillator, and then again do that result. Again, it's the same ones that I just showed you, a couple extra ones, but again, none of them are cup and handles today. But that is a way that you can find them and again filter them in. So now, why is this? Why are we not finding a lot of potential cup and handles? Well, again, we can think about this in terms of the big picture. And the big picture, what is our market really doing right now? So is the conditions of a cup and handle, or is the broader market making those type of conditions, or those variables that we just talked about? And we can look at, let's say, for instance, the S&P here. Yeah, the market is not in that kind of that basing consolidation. It's not gathering energy, right? It's not coming off a transitional low, right? We've actually made, the market has made several new highs, and we are actually now reversing off of high. We're in a more of a corrective stage. So the market is not conducive of creating a lot of cup and handles right now. Does that mean that there's not cup and handles being created? No, it doesn't. There's always markets, right? There's always a bull market. There's always some. There's always potential for cup and handles to be developed. My point is that the broader market can help influence the development of cup and handles. Again, think of that fractal nature through all of our equities. But let's look at this in terms of a big picture here. And again, this is a weekly chart. And what do we see here, right? A supportive moving average, long-term moving average, a cup-like action in our intermediate moving average, our handle where we have a slight decrease in price action that re-engages our supportive moving average, and then that breakout of price action. Now let's check this in terms of volume. I think we'll see a similar story. And again, peak volume at the kind of near the bottom as we're starting to turn up. And then again, as we're breaking out, we're starting to see some greater volume. Now this one probably, on a weekly basis, we probably wanted to see a little bit more of volume on this one. So this one might have been a harder one to swallow or at least take. But I bet you during this time, right in this time frame, I bet you saw multiple cup and handle formations in multiple of equities. All right. One more question. See, Jay says, how do you use these in futures markets? So Jay, again, it's about the duration of time and also volume. So you can definitely find these in futures market. I think I had one in my watch list. Let's look. Here's coffee. I didn't think it was a great example when I was first looking at it, but yeah, there you go. Right? Again, right? There is your cup action, right? Your supportive moving averages. Again, if you visualize this without the intraday noise, right? There it is. There's your nice little cup. There's your little handle. And again, our supportive moving averages. Again, look at our volume here, a little bit of peak volume on the high, peak volume on the low, and then there's that peak volume as we're breaking away. So Jay, you can definitely use this type of cup. Oh, excuse me, that is not the coffee. My bad, sorry. Yeah, there we go. There's our supportive moving average. There's our roundedness. Again, here our handle is much longer. Not a big fan, but again, look at our our volume. Again, this kind of reminds me of something else I was thinking about is when I was setting this up is here's that Forex. And again, Jay, this is what you might see more in the futures market is notice that here's that rounding bottom action. And then again, there's our handle and our breakout. But no, look at our volume here, folks. And this is, again, why volume is very important. Notice that our volume pattern, it looks like a cup and handle, right? There it is. I kind of show you this rounded action, and then there's our handle, and then our breakout of a handle. So again, looking at volume, there could be a distinct pattern in terms of, let's say, smoothing our volume on a moving average basis that it can help you identify some of these patterns. Okay. All right. Let's see one more. Okay. All right, so let's sum up here. What are some key points to remember? Remember the pattern duration. The cup takes a much longer time to develop than the handle. We just looked at equities. Again, something like 7 to 60 weeks could be the time. We looked at a couple of examples in terms of Forex and futures where it took a long period of time for these. But the main point is that we want to see a much longer period of time for a cup than a handle. Volume trends, right? That pattern of volume price action, right? That's lower volumes during the cup and handle formations and spikes of volume on the breakout. Confirmation tools, right? I showed you a very easy tool to confirm your breakout, and that would be a multiple of our average true range. Again, each trader is unique and your time frame might be different, but again, my philosophy is somewhere between 1.5 and 2 times the 20-day moving, or excuse me, average true range. A retest. Again, what is the real benefit of a cup and handle is identifying a new uptrend or the continuation of an uptrend. So after that initial thrust, when we break away from the cup, when the handle gives us that breakout, often we get that retest entry near or around where our handle was. That second opportunity to re-enter this trend. Failures. If price breaks out and we don't get that ATR confirmation or it breaks out on low volume, then be suspective of that this might be a failure and that the pattern might become invalid. A real important reason why we want to manage our risk, why we want to have those stops in place as we're taking that trade. And finally, that last little piece, fractal recognition, that you can see cup and handle patterns appear in lower time frames, and these are positive confirmations. In other words, inside our handle at a lower time frame, we see a cup and handle pattern. This is a positive probability confirmation. Okay. All right, Gene, right at the top of the hour. How about that? Sometimes even I surprise myself. Okay, folks. So I hope you enjoyed today's session, and I appreciate you guys being here today. I think we got answered most of folks' questions. If you have any questions and I didn't answer your questions, please send them to support@barchart.com. All of our webinars eventually will fall into our archive webinar page, and then you can go in here, you can see I'm mastering our cup and handle. If you go in there, you can also download the slides that are related to today's session. Next week, we are off. So in 2 weeks, we'll be back. Look for on email. If you're not signed up, learn how to sign up for that. So we're going to do a webinar in about 2 weeks. Until then, folks, thanks for being with me. I really appreciate your attendance. The best of health, manage your risk, and the good of all trading.